Financial statements are the heartbeat of your bank. They tell a story of your bank's financial health, its performance, and its potential. Understanding these statements is key to making informed decisions. Whether you're a seasoned banker or just starting out, these documents are your roadmap to success. Think of financial statements as your bank's financial report card. They provide a snapshot of your bank's financial position at a specific point in time. These statements are crucial for attracting investors, securing loans, and building trust with customers. Transparency in financial reporting is paramount in the banking industry. It's not just about compliance, it's about building confidence and ensuring the long-term sustainability of your institution. By mastering the art of creating and interpreting financial statements, you gain a competitive edge in the market. You empower yourself to make strategic decisions that drive profitability and solidify your bank's reputation. Now let's unlock the vault and delve into the world of bank financial statements. There are three primary statements you need to be familiar with: the balance sheet, the income statement, and the cash flow statement. The balance sheet provides a snapshot of your bank's assets, liabilities, and equity at a specific moment in time. It's like a financial photograph, capturing the essence of your bank's financial position. The income statement, also known as the profit and loss statement, tells the story of your bank's financial performance over a period of time. It reveals your revenues, expenses, and ultimately, your net income, the bottom line of your bank's operations. Finally, the cash flow statement tracks the movement of cash both into and out of your bank. It's like a river, showing the ebb and flow of money through your institution. Together, these three statements paint a comprehensive picture of your bank's financial health, performance, and future prospects. Let's start with the balance sheet, a fundamental financial statement that provides a snapshot of your bank's financial position. It's based on a simple equation: assets equal liabilities plus equity. Assets represent what your bank owns, your valuable resources that can be used to generate revenue. Think of them as the building blocks of your bank's operations. Liabilities, on the other hand, represent what your bank owes to others. These are your financial obligations that must be met to maintain your bank's credibility. Equity, the final component of the balance sheet equation, represents the residual interest in your bank's assets after deducting liabilities. It's the foundation upon which your bank's financial stability rests. By understanding this fundamental equation, assets equal liabilities plus equity, you gain valuable insights into your bank's financial strength and stability. Assets are the lifeblood of your bank, representing everything your institution owns that has value. They are the resources that fuel your operations and generate revenue. There are two main categories of assets: current assets and non-current assets. Current assets are those that are expected to be converted into cash or used up within 1 year, such as cash, accounts receivables, and short-term investments. Non-current assets, on the other hand, are those that are expected to provide economic benefits for more than 1 year, such as property, plant and equipment, long-term investments, and intangible assets. Managing your assets effectively is crucial for maximizing profitability and ensuring the long-term sustainability of your bank. By carefully selecting and investing in the right assets, you can position your bank for growth and success. Section 5. Liabilities. Navigating financial obligations with confidence. Liabilities are the flip side of the balance sheet, representing everything your bank owes to others. These are your financial obligations, and managing them prudently is essential for maintaining your bank's credibility. Just like assets, liabilities can be classified as either current or non-current. Current liabilities are those that are due within 1 year, such as accounts payable, salaries payable, and short-term loans. Non-current liabilities, on the other hand, are those that are due over a longer period, typically more than 1 year. These include long-term loans, bonds payable, and deferred tax liabilities. Understanding your bank's liabilities is crucial for making informed financial decisions. By carefully managing your obligations, you can ensure that your bank has sufficient liquidity to meet its short-term obligations and the financial flexibility to pursue long-term growth opportunities. Section 6. Equity. Building a strong foundation for your bank. Equity is the foundation upon which your bank's financial stability rests. It represents the residual interest in your bank's assets after deducting liabilities. In simple terms, it's what's left over for the owners after all debts are paid. Equity consists of two main components: paid-in capital and retained earnings. Paid-in capital represents the funds invested in the bank by its owners, while retained earnings are the accumulated profits that have been reinvested back into the bank over time. A strong equity base is essential for attracting investors, securing loans, and withstanding financial shocks. It provides a cushion to absorb potential losses and signals to stakeholders that your bank is financially sound. By understanding the components of equity and how it is calculated, you gain valuable insights into your bank's financial strength and its ability to generate long-term value for its shareholders. Section 7. The Profit Picture. Understanding the bank income statement. Now let's move on to the income statement, also known as the profit and loss statement. This statement reflects your bank's financial performance over a specific period, typically a quarter or a year. The basic formula for the income statement is straightforward. Revenue minus expenses equals net income. Revenue represents the income your bank generates from its core operations, such as interest income from loans and fees from various banking services. Expenses, on the other hand, are the costs incurred by your bank in the process of generating revenue. These include operating expenses such as salaries, rent, and utilities, as well as non-operating expenses such as interest expenses on borrowings. The difference between your bank's revenue and expenses is its net income, also known as profit or earnings. A positive net income indicates that your bank is profitable, while a negative net income indicates a loss. The income statement is a valuable tool for monitoring your bank's profitability, identifying areas for improvement, and making strategic decisions to enhance your bottom line. Section 8. Revenue fueling the engine of growth. Revenue is the lifeblood of any business, and banks are no exception. It's the income generated from your bank's core operations, the fuel that drives your growth and profitability. For banks, revenue streams can be classified into two main categories: interest income and non-interest income. Interest income is the revenue earned from lending activities, such as interest charged on loans and mortgages. Non-interest income, on the other hand, is derived from fees and charges associated with various banking services, such as account maintenance fees, ATM fees, wire transfer fees, and investment advisory fees. Diversifying your bank's revenue streams is crucial for mitigating risk and ensuring long-term sustainability. By exploring new markets, expanding your product offerings, and enhancing customer relationships, you can create multiple avenues for revenue generation. Section 9. Expenses managing costs for sustainable success. Just as revenue is essential for growth, managing expenses is equally critical for achieving sustainable success. Expenses represent the costs incurred by your bank in the process of generating revenue. Effective expense management involves striking a balance between controlling costs and investing in growth opportunities. It requires careful planning, monitoring, and continuous improvement efforts to optimize efficiency and maximize profitability. There are various categories of expenses, including salaries and benefits, rent and utilities, marketing and advertising, loan loss provisions, and technology expenses. By closely monitoring your expenses, identifying areas for cost reduction, and implementing efficient processes, you can improve your bank's bottom line and enhance its overall financial health. Section 10. Cash is king. Demystifying the cash flow statement. The cash flow statement is often considered the most important financial statement, as it provides a clear picture of your bank's cash inflows and outflows. It answers the critical question: where did our cash come from and where did it go? The cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Operating activities relate to your bank's core business operations, such as cash received from customers and cash paid to suppliers. Investing activities involve the purchase and sale of long-term assets, such as property, plant, and equipment. Financing activities relate to activities that affect your bank's capital structure, such as issuing debt or equity and paying dividends. By analyzing the cash flow statement, you gain valuable insights into your bank's liquidity, its ability to generate cash from its operations, and its overall financial health. Section 11. Ensuring accuracy, the cornerstone of trust in banking. In the world of finance, accuracy is paramount. When it comes to your bank's financial statements, even the smallest error can have significant consequences. That's why it's crucial to implement robust internal controls, establish clear accounting policies, and invest in qualified professionals to ensure the accuracy and reliability of your financial reporting. Remember, your bank's financial statements are more than just numbers. They are a reflection of your institution's integrity and transparency. By upholding the highest standards of accuracy, you build trust with your stakeholders and solidify your bank's reputation in the marketplace. So, embrace the power of accurate financial reporting and watch your bank thrive in the years to come.